Muhammad Khairi. So let's start with chapter 33, which is Audit of Cash Balance. And learning objective 1 will explain the relationship of cash in the bank to the various transaction cycle. So there's two parts, which is the first one is a misstatement, which may not be discovered from audit bank reconciliation. First one is a failure to bill a customer. So what is failure to bill a customer? Failure to bill a customer refer to the situation where a business failed to invoice or bill a customer for goods or service rendered. This can result in lost revenue and can have a negative impact on the company financial statement. So let's move on to the second one, which is the embezzlement of cash receipt. Embezzlement of cash receipt from customer refer to the misappropriation of cash that is received from customer by an employee or an individual with access to the company cash handling procedure. This can cause of loss in revenue and can have a significant impact on a company financial statement. And the misstatement failure to bill customer and embezzlement of cash receipt can be found out from part of audit sales and collection cycle. So the third one is a duplicate payment. Duplicate payment refer to the situation where a company pay the same invoice or bill twice, which is 2 times, resulting in overpayment. This can happen due to error in the company accounting system or human error, such as the same invoice being entered twice in the system. The fourth one is the improper payment of personnel expenses. Improper payment of personnel expenses is refer to the situation where a company pay for personnel expenses of an employee or member of the management team, such as their personal bill or expenses that are related to the business. This can be done by intentionally or unintentionally and can result in misallocation of company resources. The next one is a payment for raw materials not received. So payment for raw materials not received based on situation whereas company pays for a raw material but does not receive them from the supplier. This can happen due to the error in the company accounting system or fraud by the supplier. So these 3 statements, which is duplicate payment, improper payment of personal expenses, and the last one is a payment for raw material not received, can be discovered in the audit of the acquisition and payment cycle. Next one is a payment to an employee for hours not work refer to the situation where a company pays an employee for hours they did not actually work. This can happen due to error in company payroll system, deliberate verification of time record by the employee, or collision between the employee and a manager. So the last one is a payment of excess interest to the related party. Payment of excess interest to the related party refers to the situation where a company pays an interest rate that is higher than the market rate to the party that has a close relationship with the company, such as subsidiary, parent company, or a significant shareholder. And this can happen due to the conflict of interest or improper business relationship. So for the last 2 can be found out in test of the payroll and personnel cycle and the capital acquisition and repayment cycle. So based on the image from the slide, the relationship of cash in the bank and transaction cycle. So the general cash account is considered significant in almost all audit, even when the balance is immaterial. The amount of cash flow in and out are larger than any account in financial statement, which can lead to susceptibility of cash to embezzlement is greater than other type of asset because most other asset need to be converted into cash first to make them usable. On this part, I will explain a lot about example and about definition. So Misstatement normally discovered in bank statement reconciliation. The first one is the failure to include check on the outstanding checklist, which is referred to the situation where a company has issued a check but it has not been presented for payment and the check is not included in the list of outstanding check. This can happen due to errors in the company accounting system or failure to properly reconcile bank statement. So as example, a company issued a check for, let's say, 600 ringgit to pay for a supplier invoice. Then the check is not presented for payment by the supplier for several weeks. And then the company does not include it in list of outstanding check. And then the company continues to pay bills and issue check without realizing the check has not been cashed. So this will cause and result the company cash balance will be overstated and the account payable balance will be understated. This also can have a negative impact on the company cash flow and profitability. Next one is cash received by client recorded in the wrong period. Refer to the situation where a company receive cash from a customer or a client, but it is recorded in incorrect accounting period, and this can happen due to the error in the company's accounting system or improper recording of transaction. And as example, I gave if the company receive the 50,000 ringgit in customer payment on December 31st, but due to the year-end closing process, the company does not deposit the funds until the 2nd of January. When the company perform its bank reconciliation for December, it includes the 15,000 ringgit as a deposit in transit, since it was recorded in the books but not deposit in the bank. So the result will make the company balance will be understated. This one is a payment or notes payable debit directly to the bank balance but not entered in the client records. So this is referred to the situation where a company makes a payment on a loans or a note payable and the bank deduct the payment directly from the company bank balance, but the company fails to record the transaction in its book. So as the example I give, let's say the company received the 100,000 ringgit loan with a bank and make a 10,000 ringgit payment on the loan. So the bank debits the 10,000 ringgit directly to the company's bank account, reducing the company's bank balance accordingly. However, the company fails to record the 10,000 ringgit payment in its own book. So the company books will not reflect the reduction in the loan balance. So what is the result? The result will make the company liability will be overstated and the company financial statement will not accurately reflect to the company true financial position.
Assalamualaikum. My name is Nur Afika binti Azuddin. So the next learning objective is to identify the major types of cash account that are maintained by the business entities. So there are 5 major types of cash account, which is general cash account, impress payroll accounts, branch bank account, impress petty cash fund, and cash equivalents. So for the first cash account is general cash account. Most of the organization will have a general cash account, this is the focal point of cash because virtually all the cash receipt and cash disbursement will flow through this account. The second one is impress payroll accounts. An impress is a cash account used by the company to pay for periodic payments and small expenses. These accounts need to replenish funds regularly while ensuring the fixed balance is maintained. So in order to improve the internal control towards the payroll disbursement, most companies create a separate impress payroll account. So the third one is branch bank account. Branch bank accounts are important to establish banking relationships in the local communities and permit operations to be centralized at the branch level. For example, In some companies, the cash deposits and disbursements for each branch are made to a separate bank account, and the excess cash will be transferred to the main office general bank account on a regular basis. The fourth one is Impress Petty Cash Fund. This account is not a bank account, but this is a petty cash account as simple as a preset amount of cash kept in a cash box for the incidental purpose. The amount in this account usually does not exceed a few $100s and will be reimbursed in 1 or 2 months. This account is also usually used to pay for small purchases that are easier to pay with cash rather than with a check. The last cash account is cash equivalents. The excess cash that is generated during certain time in the operating cycle that will be required in the very near future often gets invested in short-term, highly liquid cash equivalents. For example, time deposit, certificate of deposit, and money market funds. This investment is only included if the short-term investment is readily convertible. This figure shows the relationship between the general cash account to the other cash account, in which all cash is originally from or deposited to the general cash account. All cash flow will go through the general cash account. For example, before making a payroll disbursement from the Impress payroll account, the cash will be deposited either by the branch bank account or cash equivalence accounts, then credited to the Impress payroll accounts to make payroll payments. This flow also same goes to the other accounts.
Okay, next in Learning Objective 3, we will learn about how to design and perform audit tasks of the general cash account. So first, we're going to take a look at methodology for designing tasks or balances for cash in the bank. Phase 1 consists of 3 things, which are identify client business risks affecting cash in bank, set tolerable misstatement and assess inherent risk for cash in bank, and third is assess control risk for several cycles. So we're going to go one by one. First is identify client business risks affecting cash in bank. So most businesses are unlikely to face major business risks that influence cash levels. However, inappropriate cash management procedures or the handle of money held in trust for others could expose us to danger. It is more likely to be caused by cash equivalents. So what are cash equivalents are? So examples is like treasury bills, treasury notes, commercial papers, certificates of deposit, and money market funds, like we have learned in bonds before. So as cash is highly liquid, so there will be risk of it being stolen and could be intentionally overstated to get a good financial statement records, which could also cover possible fraud in the business. So second is set tolerable misstatement and assess inherent risk for cash in bank. So given that cash is more vulnerable to theft than other assets, there is significant inherent risk for the objectives of existence, completeness, and accuracy. So what is inherent risk? Inherent risk is the risk that is created by a financial statement inaccuracy or omission that is caused by a reason other than a lack of internal control. Auditors will usually use inherent risk to assess the potential of substantial misrepresentation in a company's financial statement that is connected with a certain line item or audit areas. Okay, and then third, we have assess control risk for several cycles. There are 2 types of control over year-end cash balances in the general account, which are controls over transaction cycles that affected recording of cash receipts and disbursements, and also independent bank reconciliations. Okay, first we're going to take a look at controls over the transaction cycles. Well, in this part, it could be said that control risk could be decreased when controls that influence cash-related transactions are running properly or efficiently as the audit tests for year-end bank reconciliation are performed. It is important to protect both cash receipt and disbursement. This is so that there will be proper internal control in the business and it could avoid any chances of fraud or misstatement happen in the business. Next, in terms of independent bank reconciliations, it is important to ensure that it's been done on a monthly basis on a general bank account by staff that is related, and also not involved in the process of recording cash receipts and disbursement. It is also an example of a good internal control in the business. Other than that, it is essential to guarantee that amount in the accounting records and the real amount of cash in the bank are the same, which are checked by related employees. After the check has been done towards bank reconciliation with proper procedure, the internal control are guaranteed to be adequate and not lacking in anything. Next is phase 2, which is design and perform tests of controls and substantive tests of transactions for several cycles. So, substantive tests are done to ensure the information is correct, while control test is done to ensure the information is maintained in a way that encourages accuracy in the business. So regardless of the outcomes of control testing, some amount of substantive testing is essential. If there are poor internal controls or critical controls are missing, significant substantive testing will be necessary to be done. So both of these are carried out during audits, which are carried out by independent businesses to assess if the financial statements are prepared in accordance with GAAP, generally accepted accounting principles (US), or International Financial Reporting Standards (IFRS), and include no substantial misstatements. It is done for several cycles like acquisition and payment cycle, inventory and warehousing cycle, and extract. So next, we're going to go to phase 3. Phase 3 consists of 2 parts. First, we are going to go through with design and perform analytical procedures for cash in the bank. So then, what is the analytical procedures in auditing? It is an audit techniques that assists to give better outcome in terms of more cost-effective, efficient, and effective audit. So, a few examples of this technique are comparing current financial statements with statements for comparable prior period, comparing current financial information with anticipated results, such as budgets or forecasts, also comparing current financial information with relevant non-financial information. So, there are many examples. Okay, next, for design tests of details of cash in bank to satisfy balance-related audit objectives. For the second part of phase 3. So, I'm going to explain regarding tests of details of cash balance, while Afika Muhammad Yunus will explain further about how it could satisfy balance-related audit objectives later on. Well then, what is test of details of cash balance mean? It is a technique used in testing cash balances, where auditors will ask the company's bankers to directly verify the balance of the bank accounts. So, it will only be given to the auditors related. Usually, the confirmation technique are used to confirm the balance are matched or not. So, how are the balance confirmed? First, by obtaining bank reconciliation from the client, where the client will make a substantial adjustment if needed. Then, auditor will verify whether the bank reconciliation that they receive are correct or not. This is when it will be needed to satisfy audit objectives, which will be explained later, just like I said earlier. After that, related tests will be performed according to the presentation and disclosure done. Review minutes and loan agreements need to be referred to see whether there are any cash limits that must be disclosed in the notes to the account. If there are, it should be recorded in the notes to the account as a notice to the management so any misstatement in the future could be avoided. That is all for my part.
Hi, I am Afika binti Muhammad Yunus. So let's proceed to the Learning Objective 3 Part 2. We have 5 audit objectives that are related in the cash balance. So the first one is the detailed tie-in, cut-off, next accuracy, assistance, and completeness. So in this chapter, the 3 accuracy, completeness, and assistance is a very important. Why you have to make sure the amount in your bank account or cash in the bank, example like 500,000, you have to make sure the 500,000 is stated, is accurate, is accessed, and is complete until to the bank statement. And for detailed tie-in and a cut-off, I have further explanation. Detailed tie-in, in short explanation, is the account balance agree with the related master file. When we talk about master file, which always relates with what? Audit trail. So I write down here the audit trail. So as you can see, it started from the source document. What you do, you record into the journal and then proceed to ledger, and we have master file, trial balance, and then we can proceed to our financial statement. So when we talk about detailed tie-in, which means you have to make sure that balance that's stated in this trial balance, okay, same amount in the master file. It means this procedure is related with the test of detailed balance, which we look backward from trial balance to master file, and this we call as detailed tie-in. So we look backward. And this related to the TODP or test of detail balance procedure. Okay. And for the next one is about cut off. Okay, cut off. In short explanation 2 is about cash receipt or cash payment that reported in proper period or appropriate period. When is the exact date that you have to cut off the transaction? You may use the test of detailed balance procedure where somehow for the cash receipt, what you have to do, you can count the cash on hand on the last day of the year, trace the deposit in transit and the cash receipt journal, and you also can trace deposit in transit to subsequent period bank statement. For the cash receipt payment, what you can do, okay, also test of detailed balance, which is record the last check number used on the last day of the year, trace outstanding check, and the cash disbursement journal. The last one, and trace outstanding check to the subsequent bank statement.
These are the procedures that are important in this chapter.
One is the bank confirmation. A bank confirmation is related to the bank confirmation letter, which means it can be received from your bank upon request, and the bank will issue the letter with the signature and then provide it to you. So the auditor usually obtain a direct receipt of confirmation from the bank which the client do the business. However, bank confirmation are not required for non-public entities and under international auditing standard. Let's say the bank did not respond to the confirmation request. What you as auditor should do? So you as auditor can send a second request or ask your client to communicate with the bank to ask them to confirm or to complete and retain the confirmation to the auditor. Okay, and once you receive the confirmation from the bank, the balance in the bank account confirmed by the bank should be traced and to the amount stated on the bank reconciliation or vice versa. If the bank found the confirmation does not agree with the schedule, auditor must do investigation on the difference. Let's proceed to the cut-off bank statement. A cut-off bank statement is a partial period bank statement with the related cancel check, duplicate deposit slip, and other document included in the bank statement. So what is the purpose? The purpose is to verify the reconciling item on the client's year-end bank reconciliation with the evidence that is not accessible to the client. The auditor have to request the client to have bank send the statement for 7 to 10 days. Which means the cut-off bank statement normally cover to 7 to 10 days period after the date on which the bank account is reconciled. Any reconciliated item should be cleared the client's bank account during 7 to 10 days period, so afterward it is not included. Last procedure is the bank reconciliation. So a well-prepared independent bank reconciliation is an essential internal control over cash. So to test the bank reconciliation is to determine whether client personnel have carefully prepared the bank reconciliation and to verify the client's recorded bank balance with the same amount as the actual cash in the bank except for deposit in transit, outstanding check, and other reconciling item. Test bank of the reconciliation is include a verification that the client bank reconciliation is mathematically accurate. Trace check written and recorded before year end, also included with the cut-off bank statement to the list of outstanding check on the bank reconciliation.
My name is Nurul Azira binti Muhammad Khalil. Now I will proceed to the next part, which is Learning Objective 4. In Learning Objective 4, we can recognize when to extend audit test of the general cash account to test further for material fraud. The first part is fraud-oriented procedures. A major consideration in the audit of the general cash balance is the possibility of fraud. The auditor must extend the procedures in the audit of year-end cash to determine the possibility of a material fraud when there are inadequate internal controls, especially the improper segregation of duties between the handling of cash and the recording of cash transaction in the accounting records, and the lack of an independently prepared monthly bank reconciliation. In designing procedures for uncovering fraud, auditors should carefully consider the nature of the deficiencies in internal control, the type of fraud that is likely to result from the deficiencies, the potential materiality of the fraud, and the audit procedures that are most effective in uncovering the fraud. Procedures that may uncover fraud in the cash receipts are include: number 1, confirmation of accounts receivable; number 2, tests performed to detect lagging; number 3, review of the general ledger entries in the cash account of an unusual items; number 4, comparison of customer orders to sales and subsequent cash receipts; and number 5, examination of approvals and supporting documentation for bad debts and sales returns and allowance. Next, we move to the extended test of the bank reconciliation. When the auditor believes that the year-end bank reconciliation may be intentionally misstated, it is appropriate to perform extended tests of the year-end bank reconciliation. The extended procedures verify whether all transactions included in the journals for the last month of the year were correctly included in or excluded from the bank reconciliation, and verify whether all items in the bank reconciliation were correctly included. Now we move to the proof of cash. Auditors sometimes prepare a proof of cash when the client has material internal control witnesses in cash. The auditor used a proof of cash to determine whether the following were done. There are 4, which are: number 1, all recorded cash receipts were deposited; number 2, all deposits in the bank were recorded in the accounting records; number 3, all recorded cash disbursements were paid by the bank; and number 4, all amounts that were paid by the bank were recorded. This is the example of statement proof of cash. And last part in proof of cash. A proof of cash includes the following 4 reconciliation tasks. Number 1, reconciliation the balance on the bank statement with the general ledger balance at the beginning of the proof of cash period. Number 2, reconcile cash receipts deposited per the bank with receipts recorded in the cash receipt journal for a given period. Number 3, reconcile electronic payments and cancelled checks clearing the banks with those recorded in the cash disbursement journal for a given period. Number 4, reconcile the balance on the bank statement with the general ledger balance at the end of the proof of cash period. A proof of cash of this nature is commonly called a 4-column proof of cash that contains 1 column for each of the 4 types of information listed above. A proof of cash can be performed for 1 or more interim months, the entire year, or the last month of the year. Now, I will pass to the next presenter.
Hi, I am Lalatu Zakira binti Samsuri. I will explain part of the interbank transfer schedule. These figures are example of interbank transfer schedule. I will explain further information later. Auditors apply an interbank transfer schedule to determine whether a client is executing. The schedule covers all the transfer to and from a client banks as well as transactions between clients banks that are made a few days before and after the balance sheet date. This is to minimize duplicate counting of funds withdrawn, and the deposit dates should have been recorded in the same reporting period. Keying happens when the identical cash deposit appears in the 2 accounts at the same time. So we move on to the next slide to know what is the keying. Keying is the practice of transferring money from one bank to another bank by wrongly recording the transaction. A check is drawn on one bank account near the balance sheet date and quickly deposited in a second account for a credit before the end of the accounting period. So for the next slide is we have two major uses of kitting. They are to inflate earnings or conceal a cash theft. First, for the inflate earnings, the company will transfer funds from one checking account to another account. The transfer will occur near year end, resulting in the deposit and withdrawal being outstanding at year end. The company will record the deposit in the current year and the withdrawal in the subsequent year. The credit side of the deposit entry is to some income statement account, resulting in an increase in earnings. The debit side of the withdrawal entry will reverse the activity in the subsequent year. For the cash theft occurs in a similar way. If the thief can generate accounting entries, the theft can be concealed by expensing the activity. The problem facing the thief is that the bank account missing funds will not reconcile to the books. This problem can be solved by the thief returning the stolen funds to the bank prior to year or month end. If funds are not available, the thief may using the same way with the previous method that I told you for the inflate earnings. Next slide is about the interbank transfer schedule should be examined for numerous reasons. The number one is the accuracy of the information on the interbank transfer schedule should be verified. To ensure accuracy, the auditor should verify the disbursement and receipt information on the schedule to the cash disbursement and cash receipt records. Similarly, the dates on the schedule for receive and disbursed transfer should be matched to the bank statement. And finally, you have to check the cash disbursement and receipt records to ensure that any transaction a few days before and after the balance sheet data have been included on the schedule. In this figure, the symbol ticks at the column number 3, which is amount. It shows that the transaction that have in cash disbursement records already included on the schedule. And also for the tick with the circle, it shows that all transaction in cash receipt already recorded on the schedule also. For the number 2 is the interbank transfer must be recorded in both the receiving and disbursing banks. For example, not in this figure, suppose an 10,000 transfer was made from bank A to bank B, but the only disbursement was recorded. This indicates an attempt to hide a cash theft. It should if they have a transfer. For example, in this figure, the transactions are recorded in the cash disbursement record, and also they record in the cash receipt. So it should be like this. For the number 3, the date of the recording of the disbursement and receipt for each transfer must be in the same fiscal year. So the dates in the two date recorded in the books at the column 4 and the 7 in this figure are in the same period for each transfer. You can see it, right? So it means they are correct. If a cash receipt is documented in the current fiscal year, but a disbursement is recorded in the subsequent fiscal year, it means the future year, it might be an attempt to conceal a financial shortage. For the number 4, disbursements on the interbank transfer schedule should be correctly included in or excluded from year-end bank reconciliation as a outstanding check. In this figure, the bank reconciliation for the general cash account on December 31st, 2011 should include outstanding check for the second and third transaction, but not the other two transactions. If you can see at the figure, that the transaction number 2 and number 3, their date are recorded in the books in the current fiscal year, but for the date paid by bank are in a subsequent fiscal year, right? It means that this will make understanding of outstanding check on the bank reconciliation indicates the possibility of a cheating. Last but not least, a receipt on the interbank transfer schedule should be correctly included in or excluded from year-end by reconciliation as a deposit in transit. In this figure, the December 31st, 2011 bank reconciliation for the savings and payroll account should indicate a deposit in a transit for the third transaction but not for the other three transaction. If you can see the transaction number 3, their date recorded in the books and that received by bank are in different year, which is date recorded in the books or in a current fiscal year, but for the date received by bank are in a subsequent fiscal year. Is this right? It means that this will overstating deposit in a transit on the bank reconciliation indicate the possibility of a cheating.
Hi, now we met again on learning objective 5, which is design and perform audit tests of the Impress payroll bank account. So, an Impress payroll bank account is a type of bank account used by a company to fund their payroll expenses. The account is funded with a fixed amount of money and has a payroll expenses are incurred. Funds are withdrawn from the accounts to cover the expenses, and then the account is then replenished at regular interval to maintain the fixed amount of funds. So I will give one example. Let's say I will take a random company which is Cocoland. Their main company account is RHB Bank, and being used to do business operation such as sales and purchases. So to make things more easier, the Cocoland use Maybank as an Impress account to make a payroll expenses, which is it is fixed payment every month and for small purchases such as stationery. So the Impress account is used by Cocoland to transfer from the main account, which is RHB Bank, transferred to the Maybank Impress account and pay for the expenses and small purchases. That's all for me. Thank you.
The last learning objective for this topic is to design and perform an audit test of Impress Petty Cash. Petty cash is a small amount of cash in hand that is used to pay any small amount of expenditure where making the payment by check will be inconvenient and costly due to the trouble and expenses of writing, signing and then depositing the check. Petty cash is known as a unique account due to the amount is often immaterial. However, petty cash accounts still will be verified in most of the audits. So, the reason of why petty cash will be verified primarily is because of the potential of embezzlement to happen and the client expectation of an audit review of the petty cash account even when the amount is immaterial.